Good morning to everyone. Thank you for coming today. As everybody knows, I think we have more or less a lot of long-term members and alumni here that the Breakfast Club was founded after 9/11. We have now been in business for over 22 years, and by business I mean providing pay-it-forward services to our members in job search and career management, and we do our best to have topics that are widely applicable to those in job search and to help them. I'll let Jerry do the specific introduction, but this one is especially one that we do every year. And the reason we do that is because the nature of the information changes so widely year to year. And it's something that we're very lucky that the practitioner that volunteers to provide this information brings good knowledge and insights to the people to help them at a time where it's very critical to address this. But even for those not in transition, again, changes year to year. You know, we change year to year in our needs change, the landscape of healthcare and the financial markets are changing so rapidly. So we've found that the topic today is one that is definitely needed on an ongoing basis. So I thank the presenters for being here today, and I'll turn it over now to Jerry, who jointly with David run our presentation committee to introduce our presentation and presenters.
Thank you, Frank. Good morning, everyone. I wanted to introduce today's speakers. Bill LaChance is an independent financial advisor. His firm offers a unique flat-fee program that combines financial planning, portfolio guidance, tax planning, and tax preparation. Prior to launching his financial planning practice, Bill spent 22 years in corporate finance in the retail industry, and before that was a CPA with a large accounting firm. Bill's a certified financial planner, as well as an enrolled agent authorized to represent the IRS. Sudha and Anand will be co-presenting. Prior to joining WJL in 2021, she had a long career in global markets, investment banking, working in India, HK, and Singapore, covering Asia and global markets. She is a chartered accountant from India and has passed the CPA and CFP exams in the US. She is also an enrolled agent. I'd now like to introduce our speakers.
Good morning, everyone. So yeah, as Jerry mentioned, yeah, my background was in corporate finance. I was in the retail industry. I worked for Target and Best Buy, and then my job was eliminated back in 2013, and I was kind of at a crossroads, had to decide whether I wanted to kind of go for one more corporate job or start this business. So I decided to start this business. But at the time, I wasn't sure, so I was still, going through a job search myself, and then I actually just typed into Google, job networking groups New Jersey, and up popped the Breakfast Club of New Jersey, and I popped into a meeting back in September of 2013, and sort of been involved ever since. So, a little bit about me. So yeah, today's presentation, we're going to be basically not trying to hit every possible topic, for folks that are in transition, but trying to hit some key points that maybe not everybody's aware of. So, as I find it better as we do these presentations, if you've got questions as we go along, instead of waiting to the end, to just kind of, either put something in the chat or just unmute yourself and just ask the question. That would be great. We'll try to stop periodically to check for questions. So, anyways, let's get started. Let me share my screen here. And we tried this earlier and it worked, so I'm hoping it works now. I'm assuming everybody can see that. Okay. So,
yes,
anyways,
we see it.
All right, perfect. Okay. So then this is kind of the agenda of the things that we'll go through. And again, if anybody's got any questions on something that we don't touch on, please, please ask. That'd be great. So the first topic we're going to talk about is health insurance, right? Which is often a big topic for folks in transition. For somebody who's not covered by a spouse that has other insurance, right? Or is not eligible for Medicare, for example, if they're over 65. Basically, they got two options, right? If you lose your job and therefore your job-based health insurance, which is either one, you can, get COBRA, Sometimes companies will subsidize the COBRA, but essentially as a COBRA is just an extenuation of whatever group coverage that you had while you were working. Most of the time you have to pay for that entirely yourself. Obviously, when you're working, the company pays typically a portion of the health insurance and you'd pay a portion. But when you have COBRA, you have to pay the whole thing yourself. And so it can actually become quite expensive, as I'm assuming many of you are aware. The other option is to go onto the exchange. And a lot of times people just kind of automatically go to COBRA without really thinking about the exchange as an option. But really, especially now the way it's structured, it is often the better option, unless your income is going to be really high. It's often the better option to consider an exchange plan. And what the exchange really is literally just a website, right, run by the state of New Jersey, where they post all the plans that the private insurers, right, so Aetna, Horizon, AmeriHealth, the different companies that want to offer health insurance on the exchange. This is just where they post their plans, and you can kind of compare. But the big deal with it is that you can get potentially a subsidy that can be quite significant. And essentially what they do is the government assumes that you can afford to pay 8.5% of your income, okay, and put that towards health insurance. And of course, what they're assuming your cost is going to be will depend on the household. So a one-person household, right, in theory, in the mind of the government, is going to cost less to operate than a two-person household, and so on. So the subsidies go up, obviously, as the household size increases, and therefore the potential subsidy that you would get, because it brings your cost of your health insurance down to that income threshold or that spending threshold that they believe that you could spend. So, for example, in today's world, a family of four with an income potentially as high as $370,000 a year could possibly qualify for a subsidy. So it's pretty significant income where you'd still be eligible for a subsidy. And what that subsidy is it's really a tax credit that the federal government is giving you in advance, okay, based on your estimate of the upcoming year. So if you're looking at 2024 income, 2024 health insurance plans, you would basically estimate your income for 2024, not 2023. It doesn't matter what 2022 was. It's what is next year going to be. And then at the end of the year, when you actually do your tax return, it calculates your adjusted gross income, which is the threshold that matters. And it gets trued up. So if you had estimated your income was going to be $60,000 and it comes in at 70, you're going to have to pay back a little bit of that subsidy that you got. Because had you put in subsidy, 70,000 as an estimate, you would have got a little bit lower subsidy. Vice versa, if your income comes in at $50,000 instead of the 60 you estimated, you're going to get some more money back at tax time in the form of a lower payment you owe the government or a higher refund, depending on what your status is, whether you owe or you're getting a refund. So that's essentially how it works. But it lowers, and it can be quite significant, these subsidies. So, for example, I mean, oftentimes if you've got folks that are, single and they don't really have any income, and their income is, $20,000, they're basically paying nothing for the plan. So basically the subsidy wipes out the premium, and so the premiums are zero. So it can be pretty significant subsidies here, particularly if you're a little bit older. The plans on the exchange are age-based. So somebody who's, say, 25, a plan might be $350. That same person, if they were, say, 63, that might be more like $750 for that same plan. But then what happens is, because they say that person, based on their income, could afford $300 a year, right? Let's say the 25-year-old is going to get a $50 subsidy to bring them from $350 to $300. The 53 or 63-year-old is going to get a $450 subsidy, bringing them from $750 down to $300. So the subsidies increase, right, as the cost of the plans increase. So it ends up being a much bigger deal for older people. Yeah.
If I could ask the question, how do these options relate or compare to COBRA?
You mean in terms of like the co-pays and deductibles and that sort of thing?
The cost versus the benefit.
Oh, well, so again, unsubsidized, right? The cost is generally going to be the same, right? So let's say it depends, right, on the size of the family who's in there. But for two people, right, a plan might be, say, $1,600 on COBRA, right? And unsubsidized, the plan might be $1,600 here, but with a subsidy, right, you could bring that $1,600 down to $400 a month, right? Depending on the income. So it's all going to depend on what your income is. And I'm just going here. These blue bars show you the max, how high the income could be before you might potentially be eligible for a subsidy. So then with a subsidy, it's going to be dramatically less expensive, generally. Not always, but generally, yeah, as a general rule. So it's a hard part when people in transition to figure out, okay, well, what is my income going to be next year, because I might get a job. And it is true that if all of a sudden you got a job that takes you over these thresholds, right, then you would have to pay back all of that subsidy that you got. But you know, for people in that situation, I generally recommend forecasting you don't get a job, right? So what income can you 100% count on, right? You know, you're going to get some unemployment, right? Maybe you've got some dividends and interest, right? What is that going to be? And start there, essentially.
Is there any app or calculator that you're aware of that the members could go to, put in, you know, their specifics and help guide them to what the best option is, given their
Sure. Yeah. If
circumstances?
you go to Get Covered New Jersey. Yeah. If you go to Get Covered New Jersey, and then let me just see the exact wording. But yeah, if you go to Get Covered Jersey, they basically have a calculator, right? So you could say explore. I think it's like explore 2024 plans or something like that. You click that, you punch in your zip code, your date of birth, right? Whoever's in the family, right? And then your projected income, and it will tell you what subsidy you're going to get. And then you can look at the plans and see, you know, what the cost of the plans is, the gross premium for that plan, and then what the subsidy amount and the net premium. So, and they have, the plans are basically different tiers. So for example, they have bronze, silver, and gold plans on the exchange. And what that means is a bronze plan, right, is set up so that for getting the premium, the out-of-pocket, right, the deductibles, the co-pays, whatever you have to pay versus what the insurance company has to pay, that on average, the insurance company pays 60% of the cost and you pay 40% of the cost, okay? The silver plans, the insurance company pays 70% of the cost and you pay 30 on average. But what that means is you're going to pay a higher premium, right? So in theory, from the insurance company perspective, they're indifferent as to whether you take a bronze or a silver plan, right? And gold is 80-20, okay? Because you're going to pay a higher premium for a silver or a gold. And then on average for them, it's going to work out the same. They're indifferent. But for you on your specific situation, it might make sense to go one or the other, right? Depending on how often you think you're going to go, what is the premium difference, right? And are you going to make up that premium difference in the out-of-pocket, you know, having higher deductibles, higher, you know, co-pays and that kind of thing.
And
So
do
it's a math
FSA,
exercise.
HSA options apply to both?
And they do have
Cobra?
HSA options, right?
Okay.
The big thing about the HSA options is really those plans, right, to be eligible for an HSA really don't cover anything until you meet the deductible. And the deductible is often very high, close to the out-of-pocket limit. So what you really have is catastrophic coverage, meaning, you know, that really the plan might have a $6,000 deductible and a $7,000 out-of-pocket maximum. So you're basically paying everything out of pocket. And what you're really buying is catastrophic. So if you have $100,000 of bills, right, you're out $7,000 and that's it, right? And the insurance company pays the other $93,000. That's essentially, but now because you have that HSA, it does two things for you, right? Number one is it's tax deductible, right? So it lowers your income. And we'll talk a little bit about HSAs later, right? But number two, it also lowers your income that's used to calculate your subsidy. Right, so you can act, and self-employed people have a lot of options to do that, right? You can put money into a solo 401k, you can put money into a SEP IRA. There's ways you can manage your income down, and that is actually going to lower your the cost of your subsidy really by, you know, it's really I think about it as reducing your tax by 8.5% essentially. So yeah, I mean, again, for most people that aren't going to have a, you know, really high income, the exchange is generally a better option than Cobra.
And
Now,
Bill,
one other,
and Bill, and for others, I did put in chat the link for Get Covered NJ, which is New Jersey's exchange, New York State of Health, which is the New York exchange, and Pennsylvania's is called Penny. So depending on the state that you live in, at least those three links are there in the chat. You're welcome to get them.
And then the other couple other things. So that if you look at that blue chart, that's where the premium subsidy might start, right? Again, it depends on your income. This is assuming somebody has a very high cost of your plan, right? So your income, would be lower if you were younger, right? I mean, the income threshold where you would qualify for something because the cost of your plan is going to be less, right? Then that little sort of reddish orangey section, what that is, there's actually two subsidies involved in the ACA plans, right? One is this premium subsidy, which I talked about and gets trued up, right? The second one is a cost sharing subsidy, and there's 3 breakpoints in that kind of bar. And what that means is if your income falls below those thresholds, right? So say, again, $69,000 for a family of 4 or $34,000 for a family of 1. Then in addition to the premium subsidy, your cost sharing goes down, meaning your co-pays and your deductibles go down. And when there's a narrow band just above that green bar where it's pretty significant. I mean, like, again, I've got clients that are single that have 0 premium, like a $250 deductible and $1,000 out-of-pocket max for the year, right? If your income is that low. Now, those subsidies don't get trued up. Right? Now, you have to be able to justify that your income is going to be that low, right? Potentially in the beginning, if you put in, $20,000 as income, and last year your income was $150,000, right? They're going to want to understand what's going on, right? And why is it going to be that low? But yeah, so that's another. And those second subsidies are only available on silver plans. And so that one, if your income is going to be such where you're eligible for a cost sharing subsidy, you're almost always going to want to pick a silver plan because those are the only ones where you get those cost sharing adjustments, the lower deductibles, the lower out of co-pays, and so on. And then the green bar, that's actually New Jersey Family Care, which is New Jersey's Medicaid program. So if your income falls below that threshold, then you actually are not on the exchange and you get referred to New Jersey Family Care, and then you would be eligible for a Medicaid plan, which is no cost, okay? The issue with the Medicaid plans is that a lot of doctors don't accept Medicaid because the reimbursements are very low. So it becomes much more restrictive on a network you might want to use, right, if you're on Medicaid. And so some people will they'll work to actually bring their income just up over the threshold. So somebody's income is going to be $10,000, right? And they want to, let's say it's a single person, they don't want Medicaid. All you have to do is a Roth conversion or take a distribution from an IRA of $10,000, and bam, now your income is going to be $20,000, and you're out of the Medicaid threshold and into the low end of the ACA threshold. And the one other thing about these ACA plans, well, first of all, this is your only option, right? Other than COBRA, meaning some people go, well, okay, I'm going to skip the ACA. I'm just going to go right to the companies. Well, you can't. There are no other plans. In other words, you're either going to get a plan through the exchange, or you have to have it through some kind of employer, either through COBRA or you have a job with coverage, right? Or unless you're 65, and then you would be on Medicare. But and so that really is the only other option. And these plans are all EPOs. They're called, exclusive provider networks. And what that means is that there is no out-of-network coverage. You don't have to need a referral to go see anybody in network. You go see any specialists who you want, but you can't go out-of-network. So for a big issue in New Jersey is, some people want to go into New York, right, to go see a doctor as cardiologist in Manhattan, for example. That you would not be able to do on any of these exchange plans. There's no PPO coverage. Like most employer plans are PPOs where you could go see, you pay less if you go to in-network doctor, but you could go to an out-of-network doctor, right, if you want, and pay more. That's not the case here, right? If you don't go, there's no coverage out-of-network. So going to New York, for example, or going to Philadelphia, generally is not going to be an option. Right? Any question?
I saw that the open enrollment is from November 1st until January 31st. So what if I need that after January 31st?
All right, so the way it works is, so basically, let me just explain why they have these open enrollment periods, right? Here's what companies don't want, right? Insurance companies. Somebody is healthy, okay, and so that they don't sign up for insurance, and now I'm sick, so now I want insurance, so I'm going to go sign up for a health insurance plan, right? That's bad for the insurance companies, right? They need to have all the healthy people, subsidizing the people that are not healthy, okay? And so there's 2 ways to manage that risk, right? The old way was underwriting. And there is still stuff with Medicare, like Medicare supplement plans, that still use underwriting as a mechanism, right? Where you go in and you can sign up anytime you want, but you got to submit to medical questions, and then based on your pre-existing conditions, you can be denied coverage or pay a significant premium, right? And it's very controversial. all of the newer programs, right? The Medicare Advantage plans, the prescription drug plans, and these ACA plans all use a different mechanism, which is open enrollment. So they're saying if you're healthy and you don't sign up for an open enrollment in the middle of the year, you get sick, you want health insurance, okay, too bad, you got to wait to the next open enrollment period. However, if your insurance ends during the middle of the year, right, they do have special enrollment periods. So, and one of them would be, hey, I lost my job in April, okay, they now give you a 60-day window to sign up for a plan on the ACA. So at that point, you have a choice, right? You could either go on a COBRA or you can go onto the exchange because you have a qualifying event, but they may ask for evidence, right? They're going to want to see the letter that says that your insurance is ending, right? In April 30th or whatever it might be. And so if you, it's the open enrollment, if you want a plan that starts January 1, then yeah, you got to sign up by December 31st. If you sign up in January, then your plan would start February 1. If it's something where your COBRA, somebody's got COBRAs ending in March, I just had this yesterday working with somebody, they may want to take it in January because you're going to start with a whole new deductible, right? If you wait till March to sign up. So if your COBRA is going to end sometime next year, it's probably worth looking at signing up for a plan January 1 so that, you don't have to start with a whole new deductible in the middle of the year, right, potentially. Or at least look to see what the cost differential is. But right now we're in open enrollment. So right now, you can switch. Like if let's say you decide I'm opting for COBRA, right? If once January 31st goes by, unless your COBRA is ending, you can't decide to switch. Like if in April, you go, I probably would have been better off on the exchange. You can't switch then because you don't have a special enrollment period. You don't have a qualifying event. Now, if your COBRA ends, right, or if it's subsidized and the subsidy ends, by the company, then you do have a qualifying event. But if it's just you changed your mind, you're too late. You're either going to have to wait till your COBRA ends or you're going to have to wait till next year's open enrollment period. And then the one thing about these limits, this is actually not a permanent situation. Basically, there used to be a cliff. Like for a family of 4 right now, it would have been somewhere around $110,000. And if you were $1 over that threshold, you lost your entire subsidy. It was brutal for people that were just over the thresholds, basically. But so when COVID hit, they extended that out so that it's now more of a sliding scale all the way until your subsidy goes to 0 using that 8.5% formula. But that's not permanent. That's only going through 2025. And in theory, unless they extend it, it goes back to the old cliff, essentially. So the American Rescue Plan, these changes, these plans that have been introduced in the last couple of years did get rid of that, as I mentioned, that eligibility cliff. So now it gets phased in. So now you can get to a much higher income. And then they also at the time increased the credits for those that were already eligible for a plan at that point. Well, and before I move on, any other questions about the ACA stuff? Okay. So a couple other medical topics. So the IRS, once in a lifetime, okay, allows you to transfer money from an IRA to an HSA. Now, an HSA, as Frank had mentioned it, is a really sweet deal, right? What an HSA, basically what they're trying to do is if you have a high deductible plan, like I talked about, where you have to pay all your out-of-pocket costs before the plan pays anything, the idea is you're going to be more judicious about going to the doctor, right? Because you're going to have to pay out of pocket for that. Let's say whatever the negotiated rate is. Let's say a doctor charges $300. The insurance company's negotiated rate for $200. You would pay that $200 until you meet your deductible, and then maybe like a $50 or $75 copay would kick in at that point. But because they're thinking people are going to be more judicious, they're trying to get and incent people to sign up for them. And the sweetener they use is an HSA. An HSA is really the best investment vehicle out there. And what an HSA is, which is different than an FSA, a flexible spending plan, which you might get through work. With a flexible spending plan, you don't have to be on a specific type of eligible plan. You can be on any health insurance plan. The problem with an FSA, a flexible spending account, is it's a use it or lose it. If you don't use it all up by the end of the year, or they give you like a 60, usually a 60 or 90 day extension, then you lose whatever you put in. So you got to be really, forecasting how much to put in there. An HSA is not like that. You've got the rest of your life to use it up. But think about it. It's like with a separate bank, typically, right? You would open up an HSA. It's almost like an IRA for health costs, right? You get a deduction, right? Or if you're working, it's pre-tax. So it's pre-tax money, just like an IRA or a 401k. But unlike an IRA and a 401k, as long as it's used for qualified medical expenses, you don't get taxed when you pull the money out. So it's not tax going in, it grows tax deferred, and it's not tax coming out. So it's a really sweet deal. So I would have my financial planning clients, right, typically try to max out their HSAs before they max out even their, the 401ks or IRAs, once you get past the company match. I mean, you want to do that for sure. But beyond that, you're actually better off funding an HSA versus an IRA or a 401k because of the tax benefit. And you can use it for Medicare to reimburse yourself for your Medicare premiums. So you'll eventually be able to use it up for qualified medical expenses. But at any rate, the IRS does, if you don't have the cash to fund an HSA, right, which would be the better way to do it. Like I did this when I first lost my job, is that you can move money from an IRA to an HSA. Now you don't get a tax deduction because the IRA is pre-tax money already, right? It's just now when you pull it out, if you're, first of all, if you're under 59 and a half, you don't have to pay a penalty. And B, if it's used for qualified medical expenses, right, you don't have to pay any tax on that money. So it's a way to get that money out of your IRA to pay for your medical expenses without paying any tax, essentially. Other advantages or other things you can do related to medical is that withdrawals from an IRA or a 401k are not subject to the 10% penalty if you use for medical expenses in excess of your 7.5% of your modified adjusted income. So if you would be able to deduct medical expenses on your Schedule A, that excess over the 7.5% threshold can be taken out, okay, and not have to pay the 10% penalty if you're, under 59 and a half. Okay. For those who are not aware, right, if you're under 59 and a half and you take money out of an IRA, for example, you're going to have to pay a tax on it and then also a 10% penalty. In this case, right, you would have to pay the tax, but you wouldn't have to pay the penalty. And then the other thing is if you take money out of an IRA but not a 401k, right, so that's a difference between the two, you can use it to pay your medical insurance premiums, not your out-of-pocket costs, but your actual premiums, and not have to pay the 10% penalty as long as you've been collecting unemployment for at least 12 consecutive weeks. So they're basically saying somebody who's been unemployed for 12 weeks, they might have some financial issues. We're not going to penalize them, right, for taking money out of their IRA. All right. And let me just make sure there's no other questions. Oh, a question. What if the IRA was funded with, if the IRA was funded with after-tax money, I mean, you could take that out anyway, to be honest, without paying a penalty because you've already taxed, it's already been taxed. So that, but it probably would lose the benefit of, you wouldn't want to do this basically with after-tax money, right? It would sort of negate the benefit of doing it. All right. All right, so I'm going to pass it on to Sudha for the next section.
Hi. So this is about the Secure 1 and 2 Act changes. So the pre-tax account changes where the RMD ages have been has been pushed back to 73 for those turning 73 between 2023 and 2032. And it's pushed back to 75 for those turning 73 after 2033. The RMD, as you know, is the required minimum distribution, which you have to take from your IRAs or 401k accounts. The age limit for IRA contributions has been removed. Inherited retirement account distributions must be taken within 10 years now. New parents can take penalty-free withdrawals, and long-term part-time employees may also now be eligible for 401k plans. The Roth account changes are additional employer contributions are now eligible for Roth. The applicable amounts are, of course, included in gross income. It applies only to matching and non-elective contributions and not profit-sharing contributions. High wage earners, those earning more than $145,000, are required to use Roth option for catch-up contributions starting in 2024. One way to avoid the Rothification requirement is change employers to keep employer-specific wages below 145K or generate earnings via self-employment income. No catch-up is allowed for anyone in the plan. If an age-eligible high-wage earner cannot make a catch-up because the plan does not have a Roth option. This is normally a small business issue.
Yeah, basically what they're saying is that, so for those who are not familiar, right, the difference between a traditional IRA and a Roth IRA, right? With a traditional IRA, you're putting the money in pre-tax now, right? Either it's pre-tax to employer, right? Or if you contribute to an IRA, you take a tax deduction on your tax return, but either way it becomes pre-tax. Then it grows tax deferred, and then you pull the money out, right? When you, when you pull the money out, it's taxed essentially, okay? And then with a Roth, okay, you're putting after-tax money in, and it grows tax deferred, and then you don't have to pay tax on either the principal or the earnings when you take it out. Now, it works out mathematically, although it may not be intuitive, that if you're in the same tax bracket, right, when you put the money in as when you take the money out, okay, you're indifferent as to whether you did a traditional or a Roth. You end up in the same place after tax at the end, right? But if your tax rate's going to be different, it's going to favor one or the other, right? High tax people earning a lot of income today in a very high income bracket are going to want to get as much money into traditional IRAs, right? And pay the tax later, and vice versa. If you're in a low bracket, which is why we'll talk about, doing Roth conversion, some things might be some things you want to do, right? If you're in a low bracket because of, a job transition, or you're just kind of, retired or whatever it might be. And so the IRS is saying, well, no, for high income people, if you're going to use that catch up, so basically if you're over 50, right, you could put, 22,500 into if you're under 50, you could put 22,500, right, into a 401k, for example. But then if you're over 50, you've got a catch up that would bring you up to 30,000, right? That catch up portion, they're saying, now, if you're high income, we know you want to defer the income, right, into the future. We're going to make you put it into a Roth today, and you pay the tax today at your higher rate, is essentially what they're doing.
So now there are some 528 to 529 to Roth IRA transfers which are allowed in 2024. The Roth IRA receiving the funds must be in the name of the beneficiary of the 529 plan, and the maximum lifetime transfer is $35,000. 529 contributions and earnings going to a Roth IRA in like kind. And the fine print is that the 529 plan must have been maintained for 15 years or longer. It's not sure as of now how a change of beneficiary will be treated. Any contributions to the 529 plan within the last 5 years and the earnings on those contributions are ineligible to be moved into a Roth IRA, subject to IRA contribution limit less any regular traditional IRA or Roth IRA contributions annually. Roth IRA income limits do not apply to this.
Yeah, and what they're really doing here is, people have a dilemma, right? If I fund a 529, what if my kid, gets a scholarship or decides not to go to college? There's penalties if you pull that money out, right, without having used for qualified education expenses. So now they're having a plan B, which is you're going to be able to take some of that money, right, that you didn't use for college and put it into a Roth IRA in that child's name. And now they have a retirement fund started, essentially.
So, Bill, I've got a question. This is for federal. What happens on the state levels?
It all depends. Yeah.
Okay.
Unfortunately, the states don't have to necessarily follow the federal government. And I'll be honest,
Okay.
I haven't run into this situation yet, so I haven't really looked into it in terms of what New Jersey's going to do. But you've got a lot of these situations where they make some kind of a federal law change, and then the state doesn't follow along, right? So yeah, you got to think about that. The thing about New Jersey is up until recently, up until the last year or two, right? You couldn't take a tax deduction on your, New Jersey for, Roth anyway, so it didn't matter, right? They didn't care, and so there was no tax benefit. There was no benefit to having it in a 529 anyway. Yeah, but that's a good point. I probably haven't done the research, to be honest, on what the impact's going to be in, at the state level.
Thank you.
Sure.
The other catch-up changes are the IRA catch-up amount is now indexed to inflation. In 2025, a new special catch-up contribution is allowed for taxpayers between 60 and 63 years of age. This limit is equal to the greater of 10,000 or 1.5% of the standard catch-up contribution limit for 2025, and that will be indexed for inflation. The other retirement changes are new emergency withdrawal exception, $1,000 a year, new qualified long-term care distribution exception, $2,500 a year, creation of a linked emergency savings account. Highly compensated individuals are ineligible for this. employers matching of student loan payments, relief for retirement plan mistakes, and this is a big one. The penalty has been reduced to 25%. It was earlier 50%, and the penalty is further reduced to 10% if it's fixed during the correction window.
Right, and the big one there is not taking your required minimum distribution, right? So the government says, hey, listen, the idea we're giving you incentive, right, by giving these tax breaks to save for retirement. That's why if you take it out before 59 and a half, you have to pay a penalty. They're thinking, hey, you're probably not retired yet, right? But by the time you're 73, they're saying, yeah, you should be retired by now. And therefore, we want our money, right? It's a tax deferred, not tax free. And so they're forcing you to take it out. And the penalty was significant. If you missed your RMD, it was a 50% penalty, although they would often waive it, right? If you had some kind of, excuse, you made up a reasonable excuse for it. And now they've reduced that penalty to 25% and even 10%. They give you a window to fix it, and then now the penalty is only 10%.
So these are some strategies to defer income or accelerate deductions if you expect to be in a higher tax bracket in the current year. One is to make additional contributions to your tax deferred investment accounts, 401k, IRA, HSA, whatever options you have. Delay deferred compensation for the following year if possible. Prepay your January mortgage payments to increase your mortgage interest deduction. Utilize donor advised funds to lump charitable deductions or donate appreciated securities if possible. Pay quarterly estimated state income taxes in December instead of January, and prepay real estate taxes if possible. The tax deduction is limited to $10,000. Sell investments at a loss. Up to $3,000 can be recognized in a single year and use proceeds to purchase a similar but not identical investment to avoid a wash sale, which is commonly known as tax loss harvesting.
Yeah, and what we're talking about here is a situation where your income is changing, dramatically from one year to the next, right? And a couple of situations that happens is one is obviously folks in job transition, right? The year that they lose their job, they may have worked a portion of the year, they may have received a severance package. If they had a deferred compensation plan, they'll often get paid out a portion of that deferred compensation in that year, and their income could be very high, right? On the other hand, if they don't get a job, in a short order, right, the following year, their income could end up being quite low, right? They're collecting unemployment, the unemployment may run out, right? And now they're forced to live off savings, right? And so they might have a very low income. And so these are tax strategies to take advantage of that differential in income. The other situation is people who intentionally are retiring or are going to start working part-time, they're transitioning in their career. So we have a lot of clients that are in their 60s, and that's often when that happens, where they're not yet collecting Social Security, they're not yet having to take those required minimum distributions, and so their income could be low. And then we take a look at, well, what is your tax rate going to be later down the road when your income is going to be high, because higher than you expect, right? Because you are taking Social Security and you are taking those RMDs. So we may want to bring some of that income forward. Right, the instinct might be just to not pay any tax and be happy about it, but all you're doing is creating yourself a bigger tax bill in the future. So we do a lot of planning with folks to say, okay, think about what is your income tax going to be over time, and when is you going to be in your lowest rate. And oftentimes people in job transition are going to be in a period where they're in a low rate, and so they want to do sometimes. Now this happens to be the first year where it was high, right? So you're trying to do is you're getting the money, the expenses into the current year and getting income out of the current year. And these are some strategies. And the next slide sort of go through is the opposite. Now you're in your low year. You want to potentially bring income into the year and get expenses out.
So how do you accelerate income? What are the choices you have to expect because you expect to be in a lower tax bracket in the current year? You take Roth conversions on an IRA or up to an amount that will fill up the lower tax bracket. You sell investments at a gain to lock in a lower capital gains rate. To the extent you're in the 12% tax bracket, your long-term capital gains are now 0%. If you're over 59.5, you withdraw money from your IRA. Or if you're under 59.5 and you qualify for one of the exceptions, you pay taxes at the lower rate, you can still contribute for that year. If you separate from your company at age 55 or over, withdraw money from your 401k and pay taxes at the lower rate without paying the 10% tax penalty. pay quarterly estimated income tax in January and defer payment of real estate taxes until January if possible. The tax deduction is still limited to $10,000. And credits you may become eligible for are the Earned Income Credit, the American Opportunity Credit, and the Lifetime Learning Credit.
All right, so I'm going to hop back in and talk about, if you have a 401k, 403b, you've left your company, what should I do with that money, right? So there's a couple of advantages to 401ks and 403bs, right? And a few advantages to having money to an IRA. So essentially, you really got three choices, right? You could either leave the money in the old company's 401k, right? You can roll, the money to a new company's 401k, right, when you get a new job, or you can roll it over to an IRA, right? Some of your options with your retirement plans, right? The advantage of 401ks, 403bs is one is you can take loans. You can't borrow against an IRA, okay? But you can borrow against a 401k up to $50,000 or 50% of the 401k balance, whichever is lower, right? And there may be some reason why you think you're going to need to borrow against that 401k. If that's the situation, then what you're going to want to do is roll that into the new company 401k. The old companies are typically not going to let you borrow against the money because they pay it back essentially. Although really you're paying yourself back, right? But you're paying yourself back, but they get it through payroll deductions. So oftentimes, if you leave a company, you're going to have to actually pay back that 401k loan, right? Otherwise, it's going to be treated as a distribution and will become taxable and potentially, eligible for a penalty if you're under, depending on your age. Okay. The second situation that favors 401ks is, and again, I think I mentioned, if you're under 59.5 in an IRA, you have to pay a 10% penalty on top of the tax that you haven't paid. With a 401k, if you separate from service, right, in the year you turn 55, okay, you can then take a distribution from that 401k and not have to pay the 10% penalty. And it doesn't have to be, it's got to be in the year. So let's say you separate from service in March, but you turn 55 in November, that counts, that's fine. Right. So what I often recommend to clients is if they're between 55 and 59.5, you generally, if there's any chance you're going to want to tap into that money, leave it in the old company 401k because you can get at that without paying a 10% penalty. And I've seen a situation where, client was talked by an advisor who wanted to manage their money and they charged a percentage of assets. And so they convinced them to roll the money into an IRA. And then they needed some money, and then they had to pay a penalty by taking it out of the IRA, where they would have been better off just leaving it in the 401k. And so something to be aware of. Now, if those two situations don't apply, then it's generally best to roll to the IRA. The advantages of rolling it into an IRA is one, it's probably not going to apply to a lot of people here, but if you no 10% penalty for first-time home buyers. The second one, though, might apply. I actually did this myself, right? There's no 10% penalty if you withdraw, for a higher qualified higher education expenses. So if you have got a child in college and you take money out of the IRA, you can do that and not pay the 10% penalty, even if you're under 59.5, as long as it's for qualified expenses. Now, be aware that that's income. So if you're also going to be eligible for need-based aid based on your income, that is going to have an impact on your need-based aid. So the strategy I did is I waited till my younger son was basically a junior in college, because at that point, the financial aid forms, FAFSA, CSS, they look 2 years back, right, to look at that income to determine that that year's financial aid. And so those last 2 years, the income really didn't matter because it's based on prior year's tax returns. Okay, so but something to be aware, but you can take money out and not have to pay a penalty if they're used for qualified higher education expenses. And there's also, as I mentioned earlier, no 10% penalty from an IRA, but there would be from a 401k if you've been collecting unemployment for at least 12 consecutive weeks. So if that's your situation, then what you want to do is roll it over to an IRA and then take the money out. Okay. The other advantage of IRAs, they have much broader investment options. Typically, when you're investing in a 401k, there might be 10 or 12 funds you could pick from that some registered investment advisor picked. Oftentimes, they got usually a few target date funds. There might be like one, S&P 500 index fund and a few higher fee funds. With an IRA, you could actually have the universe of funds to pick from. You could put in one to Vanguard, index funds, or or Fidelity index funds, which we tend to be fans of. But you got a lot different options. Now, if you're going to take the money out of a 401k and give it to a financial advisor and pay them, 1%, and then maybe potentially even end up in higher fee funds, well, then you're not going to be better off doing that. So you want to be aware of the fees, which I'll talk about in a little bit. But assuming you're just going to throw the money over at Vanguard and buy index funds or something, you've got a lot more options. Okay? And then the other advantage of IRAs, as we talked about, is you can do Roth conversions, right? So you can, and I talked about earlier, the difference between traditional IRAs and Roth IRAs, well, you can move money and there's no limit on it, right? As much as you want every year from a traditional IRA into a Roth IRA, right? That money will now grow tax-free. You pay the tax in the current year if you want to bring your income up. Examples might be, like we talked about, somebody doesn't want to be on Medicaid, so they do a Roth conversion to get their income above that Medicaid threshold. It could be that you're going to be in a 24% bracket later in life, right? Or 22, you're 12% now. I'd rather pay tax at 12%, but I don't need the cash, so I'm just going to do a Roth conversion, put that money into a Roth IRA that'll grow tax-free forever, and now I don't have to pay tax on that later as part of my required minimum distributions. So IRAs give you the flexibility of doing that. Okay, and it's also possible that you could do both, right? Depends on the company. Some companies will only allow you to take, all of the money or none of it, but some will allow you to take a partial distribution, in which case you can roll some to an IRA and some to the new company's 401k, right? Depending on what makes the most sense for you.
There is a question in chat.
Yeah. If you've exhausted all, would you have to pay a 10% penalty for IRAs withdrawals? Yeah, no, as long as you've been on the 12 weeks, at least 12 weeks, you would be able to take the money out and not pay the 10% penalty. Because basically when you do your tax return, right, whoever the IRA provider is, they're not going to know what you did with the money, right? They're going to say this was a non-qualified distribution, right, and not a regular distribution, and therefore it would be subject to the penalty, right? Then the IRS, and on the there's a form you fill out. I forget the numbers on it, but there's a form you fill out that then gives you a bunch of exceptions. You would check one of those things like, I paid for, first-time home buy, what I'm listing here, right? Higher education expenses. There's a couple of other things that I haven't mentioned, and then this would be one of those exceptions. You check that box, and then the tax software takes away the 10% penalty. So the answer is no. You wouldn't have to pay the 10% penalty as long as you've been on there for 12 weeks, right? Now, it would only be if they audited you that you have to prove that, right? That you had 12 weeks of at least 12 weeks of unemployment. But I think if you haven't gotten a job since then, that would be totally within the realm here of what would be acceptable. Next slide, just talking a little bit about, if you have been out of work for a while, right, and now the money is tight and you have to take on some debt, some things to think about, right? If you have access to lower rate source of credits, right? So if you have a home equity line set up, right, that is going to be a lower rate than, say, putting something on a credit card, for example, right? If you've got a whole life policy, right, that has some cash value to it, you can essentially use, like similar to a home equity loan, right? You use the cash value in your whole life policy as collateral, and you borrow. You can either go to a bank or you can borrow from the life insurance company, right, and use that as collateral. And that's typically going to be a much lower rate than what you'd have to pay on a credit card debt. And even within credit card debt, understand the rates that you're paying. Things like cash advances will often have higher rate and kick in immediately versus purchases. So just be aware of the rate you're really paying. It's always a good idea, right, to verify your credit reports. Now, the credit reports are a little bit different than, your credit score. So essentially, there's three big credit reporting agencies, right? TransUnion, Experian, and Equifax. And what they are is basically data collectors. They're collecting all this data on you, right? From all these people that are reporting, your payments on your credit cards, payments on your mortgage, and whatnot. And then they have this big database, right? And then there's companies that run algorithms that then analyze that data and come up with a score, right? The most well-known one is Fair Isaac. It's called the FICO score. They basically, run an algorithm against that data and come up with a score. And so now you can't get necessarily access to that FICO score, but you can get access every year. You're required to be able to view the history, your credit history from the credit card company. From the credit data, the data collection agencies, okay? And I think it's freecreditreport.com, right? And the government requires that. So it's probably not a bad idea to go and look. We had an issue with some medical bill that we thought was all taken care of, and it created an issue when we went to go refinance our mortgage. So you just want to be aware of what's out there and address any issues. You know, if you do have credit cards, right, you don't want to get close to maxing it out, right? Maxing out your credit card is going to have a negative impact. You basically want to keep, you know, if you can, those balances under 30% of your limit before it starts to have a negative impact on your credit score. You want to pay more than minimum due, right? That has a negative impact on your credit score. And of course, the big one is if you miss a payment, right? Certainly if they go into collections, right, that's going to have a significant impact, negative impact on your credit score. My next thing is about college. You know, obviously, you know, because as I mentioned, right, for those who have kids in college, you know, the FAFSA and the CSS, you know, the two main financial aid documents, those are generated well in advance, right? You know, a year and a half to 2 years in advance of, you know, the year it's going to be used. And so obviously things change, right? So if they do, you know, you're going to want to reach out to the financial aid offices. Some financial aid offices are going to be able to help. Some aren't going to be so flexible. It all depends. State schools tend to be have less wiggle room in terms of what to do than private schools. But you're certainly not going to get anything without asking. And it's just more not necessarily specific to folks in transition, but just a general thing about college is that most of the financial aid that's out there is not actually need-based anyway. So even if your income, you do get a job and your income's good, doesn't mean you can't, you know, your child can't get financial aid. It's just it's going to be more merit aid. And merit aid is really just a discount, right, to get some student that they're trying to entice some student to go to the school. Oftentimes it's based on academics, right? So essentially, most schools are out there trying to raise their academic profile, which is going to make them more desirable, which is going to, you know, increase their, you know, number of applications and so on. So they're not coming an arms race to try to, you know, work their way up that sort of selectivity scale. And so what they'll do is, you know, students in the top, you know, quarter of the class, they're trying to really incent those students to come. And essentially what's happening is the students in the bottom half of the class are subsidizing, right, those students in the top quarter of the class. So then the question is finding the school where your students in the top quarter of the class, right? So, and there's a hierarchy, right? So, you know, a student who can get into Duke, right? You know, a school like Lehigh, which is a really good school, but they may want that student, right? So they'll offer them a merit package, and the student getting Lehigh, you know, Muhlenberg might, you know, offer that student incentive, and it's all the way down the line. So you, as long as your, you know, student is flexible about where to go, there's going to be schools out there that are going to offer significant aid packages to try to entice them to come. Now, if they're just getting into their reach school, right? And of course, the top schools, the top 20 schools, the Dukes of the world and the Ivy Leagues, the Stanford stuff, they don't do any merit aid because they don't need to, because they're turning away 96% of the people who apply anyway. But once you get out of even that top 20, the schools generally offer some kind of a merit aid package. Some of it could be geography, right? Schools want to expand their geographic base. Both my sons, we used to live in Minnesota. Both my sons applied to Minnesota schools because those schools are really not on the radar with the New Jersey crowd. And so they both got really nice merit aid packages from schools in Minnesota because of that. You know, if it's Boston or Washington, D.C., not as much, right? Those schools are swamped with students from New Jersey, so they're not necessarily looking to bring more kids in from New Jersey, right? But somewhere in Ohio might, right? So it all depends. Could be things like, you know, your kid's a violinist, right? And the orchestra needs violin players or whatever, and they might offer you an aid package to get you to come. So whatever it is that they want you, you know, in their student body, they offer a discount essentially. And as I talked about, monies in the IRAs can be taken out without paying a 10% penalty, even if you're under 59.5, if you use for qualified higher education expenses. Okay. Next is just kind of my little rant on investment fees. Something you just really want to be aware of, like what are the fees? You know, we're big believers in what are called index funds. Index funds are funds that where essentially you're basically, they're not trying to beat the market, right? So let's talk about large cap US, right? Index fund essentially owns all 500 stocks in the index, right? There's nobody doing any analysis, just a computer, right? And so the fees might be 0.02% or something. They still have to manage it. They still got to send out reports and stuff, but the fees are very low. Versus you might have an actively managed fund focusing on US large cap, where they might charge, you know, 1% or 0.8% or something. And now they have a team of people analyzing companies, this and that, to try to figure out which of the companies we want to own, which sounds good in theory. The problem is it's a zero-sum game, meaning the market average, the market is the average of all of these individual players. And so by definition, half of those people doing the analysis right, are going to be better than the market in any given year, and half are going to be below the market, because below the market is the average of all those decisions being made by all those market players. But that's before fees, right? They're charging you a fee to do that, right? And so then the question, how many will, generate enough of a return to beat the fee that they charge? And then in a given year, it drops down to about 30%. And of course, it's not the same, person every year. Over 15 years, that number drops to like 18%. So if you knew at the beginning who the 18% were going to be that were going to beat the market, you'd give them their money. The problem is there's no way to know at the beginning, right? You can know at the end, right? It's easy to look back, but there's no way to know at the beginning. So you got an 82% chance of being wrong, 18% chance of being right. So we're instead big believers in what they call these index funds, right? The fees are very low. You own the entire market. You're not trying to beat the market. You're just going wherever the market goes. But the market overall has delivered, 8 to really 9% return over long periods of time. Just because companies are out there trying to beat their cost of capital, right? They're all trying to get a 15%, earnings growth, and on average they end up around 9, right? And so, if you believe that, you could still do that, then that's the way to go. And so that's where big believers is, don't pay fees. So that 1% fee you might pay for an advisor to manage your funds really adds up over time, right? And a $250,000 portfolio over 30 years, going to reduce the ending portfolio by $600,000. So it's pretty significant. It doesn't seem like a lot, 1%, but it really adds up because of the compounding. So just be aware of fees that you're paying, and it's hard to beat the market, and so it's hard to justify the fees. And then the last slide we got is just going to, again, my rant on Social Security. When should you be thinking about taking Social Security? A lot of people talk about it in terms of break even, and the break even say between 62 and 70, which is 62 is the earliest you can take it, right? 70 is the latest. I mean, you could take it after 70, but it doesn't grow after 70, so it wouldn't make any sense. So for all intents and purposes, 70 is the latest you can take it. Break even's around age 80-ish, something like that. But I don't necessarily think break even is the way to think about it, right? Because from a retirement standpoint, what you're really trying to do in retirement is make sure you have enough money to last as long as you live, right? That's the point. Not to necessarily get as much money from the government as you can. That's not the point of retirement, right? So, in this scenario, I just read a couple of numbers saying, let's say, you filed at 62, the earliest age, but then in scenario one is you live to 72. So if you knew what was going to happen and you knew that you were going to get hit by a bus at 72, yes, you would be better off filing at 62 for sure. And on the other hand, if you knew you were going to live to 95 for sure, you'd be much better off waiting till 70 because you're going to have all those extra years. Because just for what it's worth, Social Security grows at about 8% a year every year that you wait. Doesn't mean you're earning 8%, right? You're getting it one less year, right? So it shouldn't go up anyways, and the break even's around 5.5%. But Social Security, it's 8%, so you are better off waiting, okay, for most people. And so I look at it and go, what if you don't know, right? So let's look at the bottom left corner, right? This is the numbers to where if you filed at 70 and then you get hit by a bus at 72, it's true, right? You got less money than the box above that, right? Where if you filed at 62 for sure. But in theory, you shouldn't have run out of money at age 72, right? If you plan for any kind of retirement. The upper right box, that really is the retirement crisis in the United States to some degree, right? About 50% of the people take Social Security at the earliest possible age, which is 62. And then most of the rest take it around their full retirement age, which is creeping its way up to 67. Only about 5% of people wait till 70. But so what you end up with is a scenario where somebody draws Social Security early, they take a lower amount, and then they're stuck with that amount the rest of their life, right? And they do live a long life, right? And it's particularly if you've got two, people with smaller Social Securities, one of them passes away. Now you've got it's usually the husband, the wife trying to live on, $20,000 or $25,000 a year Social Security, right? And that's where we've got a big issue out there. On the other hand, right, if you've got two corporate earners, for example, two pretty good incomes over 100,000, and right now, if they're at 70 and they're taking Social Security, their combined income would be about $105,000. So you could get a pretty good income just from Social Security if you're willing to wait to 70. Doesn't mean you got to work till 70, right? You could retire at 63 or 64, okay, and just live off the portfolio from 64 to 70 and hold off on the Social Security. Now that's counterintuitive to a lot of people. People think it's going to be safer to draw out of Social Security and leave the portfolio alone, But by doing that, what you're doing is you're then taking the pressure off the portfolio because you're getting that higher Social Security and a higher guaranteed floor of income from age 70 for the rest of your life. So it actually makes it safer. Now, some people can't do it, right? They literally have no other option, right? They can't work or whatever it is, and they're going to have to take it at 62, but that's what they're going to live off of, right? But most of the people that, of course, that come to us as financial planners have the resources to make it to 70 by living off their portfolio. And it also gives you all the tax planning stuff that we were talking about earlier, opportunities. So most of my clients, the vast majority, we recommend waiting until 70 to take it. But my little kind of thing on Social Security. Opinions on moving dollars to a QLAC. Yeah, QLAC is a qualified annuity. Yeah, and that could work, right? It all depends. The advantage of whether you did a QLAC or an immediate annuity, and a QLAC is basically you're able to take, you're able to avoid some of your RMDs essentially by taking some of that money in your IRA and basically putting it into a qualified annuity that isn't going to start paying out to you're age 85. So you're basically pushing off your RMDs. So annuities can definitely make sense for the right person. For those who are not familiar with it, what a pure annuity is you would basically take a lump sum of money, give it to an insurance company. You're basically buying a pension, right? And they're going to give you a stream of income for the rest of your life. So the insurance company is able to add value in that situation because what they're doing is they're putting your money in, right, along with all these other people, right? And the idea is that everybody wants to have enough money as long as they live, right? So if there's a big enough pool of people, some people are going to die early, some people are going to live long. And what's happening is the people that die early are funding the people that live long. And so if your main concern is you not running out of money, there is a value potentially in doing an annuity. So for example, somebody age 70 might be able to get 7% out of the annuity. It doesn't mean they're earning 7% because some of that money is their own money. But basically, if I give the insurance company $100,000, they're going to give me $7,000. Or if I give the insurance company $1 million, they're going to give me $70,000 a year for the rest of my life, basically. Okay. And so the idea is, and I don't know if people have heard of it, but some people, they're out there a lot in the financial planning world that the safe withdrawal rate from a portfolio is 4%. And the reason being, with a portfolio, you got to worry about market fluctuations, right? If the market goes way down like 2008 or even 2022, right, while you're drawing, that's going to put, you got to be careful that you don't know what those fluctuations can do. So you have to withdraw conservatively from the portfolio. So in this case, with an annuity, you can get $70,000 a year if you had $1 million. Out of the portfolio, you might be able to safely draw 40. So if that $30,000 difference is going to make a difference to your life and you don't care that there's money left at the end. Now, the big difference is with the portfolio, you're drawing 4%, but if you're earning, say, 5% on average in the portfolio, you're going to have a big pile of money at the end to give to go to your estate. Whereas with the annuity, once you die, that's it. The money stops. So you could spend more money on yourself, but there's going to be less money, right, in the estate. And so it depends on your priority. So there are situations where annuities make sense. The problem in all, if people have heard controversy about annuities, is that portion of it is not terribly profitable for the insurance companies. They want to get involved in building up that portfolio in the first place. And that's where all the fees and all the bad things you heard about annuities come in, because there's really not any value the insurance companies can add in the accumulation of the lump sum, because they're investing in the same investing options you have, right? So there's no advantage that they have over investing over you, but the fees are going to be higher. So you're better off accumulating your own money and then deciding later, right, whether it makes sense to annuitize or just draw from the portfolio. In terms of living. It all depends on whether that difference is going to make a difference to your life or not, and how you want to prioritize it. But a qualified annuity is just a form of that, where you would actually be able to use qualified money on an IRA and avoid, push off essentially the RMDs into the future. Any other questions on all of that? Okay, so then here's our contact information. I do have kind of this little side business on the health insurance. So if anybody does need it, there's no fee for that, because I do get a small commission from the insurance companies for, whatever we sign up. So if you do need help with health insurance, reach out. And obviously, if anybody wants to talk about the financial planning stuff, they're certainly welcome to reach out to us. That we do charge for.
Okay, thanks, Bill. Thanks, Sudha. Any questions for Bill or Sudha while we still have them on the session today? now's a good time to get some of your questions answered, a little bit of advice.
And we're also going to get this, I'm going to get this presentation out to you guys. I'm going to send it over here in a little bit.
Oh, terrific. Yeah, if you send me the slide deck, we'll be able to post that on the website. And the video will be, we recorded this session, so the video will be on the website as well. I'm sorry, on the YouTube channel, which is accessible from the website. But while you have Sudha and Bill here, if you have a question or two about anything they covered or something maybe more specific, now's your opportunity.
So I have a question on the true up for the insurance. Does it work fully both ways? Like if you estimate a particular income and make more, you have to pay back what you got as subsidy. But if you make less, what does it work both ways?
Yeah, you get more money back. What they're really doing is they're saying, okay, you now know your adjusted gross income, right? You're doing your taxes at the end of the year.
Mm-hmm.
If you now went back in and punched that into the, Get Covered New Jersey system and said, what would your credit have been based on this exact income? And then it gets adjusted to that. So to your point, yes, if your income comes in lower than your estimate, you're gonna get the difference in a lump sum when you do your taxes. If you come in higher than your estimate, you're gonna pay the difference in a lump sum when you do your taxes. So it works both ways.
Then, but if you're in that middle section where they subsidize your actual co-pays and whatnot,
that does not get trued up. So that's the reason, that's the rationale. Because again, I've worked with folks who go, well, but I might get a job, so I'm going to put half of what I might earn for the year in there. I'm like, no, don't do that, because you might not get a job. You don't know that, right? And the subsidy and that, if you're going to qualify for a cost sharing subsidy, that doesn't get trued up.
Mm-hmm.
You're generally going to want to estimate your income the lowest amount that you can legitimately justify, that you know is coming in. You know you're going to have this much unemployment. You know you're going to have this much, dividend interest income or whatever it is. Whatever you know you're going to have, you have to put that in. You can't just, make up an arbitrary low number, right, just to get the cost sharing subsidy. But assuming that's legitimately what your income is, then put that number as if it comes in higher, you're right. The premium subsidy then gets trued up, but the cost sharing won't. And, and people say, well, what if I get a job? I have to pay it all back. Well, if you get a job early in the year, right, well, then you shouldn't have had too much of a subsidy to pay back, right, a couple of months, right? If you get a job really late in the year, well, then in reality is your income's not going to be that high anyway, so you're probably not going to pay that much back. In the middle of the year, it could be significant, but still, that you got a job, right? So in the big scheme of things, that's probably a good thing, right? In fact, you got to pay back some of the subsidy. There's worse problems to have at that point. I mean, it's just the way it works, but yeah, so but that part doesn't get shipped, which is why if you're not sure, you're going to want to estimate low to whatever the lowest amount you could support, basically. Now it creates an whole other issue if you have kids under age 18, because now those thresholds I showed you for Medicaid, those are the thresholds for adults. The children threshold is much higher. It's actually 350% so for a family of 4, it's like $110,000. If your income is less than $110,000 and you've got, say, children under, or teenagers or something under 18, it's going to send the children to Medicaid and the 2 parents will go to the ACA. And a lot of families don't want that, right? And so then okay, what do we got to do to get your income above that $110,000, right? So that your kids don't go, onto Medicaid. And then, again, anybody who's got an IRA can actually getting your income up is really easy to do, as long as you got an IRA or 401k by just taking a distribution, because that's income, right? So you could force the income up to whatever you want it to be. You got to get down, it's a little trickier. But again, as I mentioned, if you got ways to bring your income down, well, then do it. It may make sense because it's going to help you with your health insurance cost.
Thank you.
Any other questions on that stuff or anything?
I have a question.
Sure.
Yeah, I have a question on inherited retirement account distributions having to be taken within 10 years. So if I inherited something, I don't know, 5 years ago from my mom, and, I've been taking, I guess, the required minimum distributions, but what does that mean? Like, as
Oh,
far
yeah,
as
no, that's for newer ones after the law was passed. So if
okay.
whatever was inherited before the law changed is grandfathered in. And the
Okay,
other
so
nuance
that's
on that 10-year, and it's still a little bit up for debate, is they originally said 10 years. And this is for stuff that were inherited. I think it passed in 2020, 2021, something like
oh,
that.
good.
So those, everybody thought, oh, I got 10 years to do it. But the IRS said, no, if the person was already taking their RMD, you still have to take the RMD every year based on your age, just like you're doing, right, for the old ones. But the difference is by 10 years, the whole thing has to come up. So it's really a planning thing to say, okay, how do we spread this out so that you pay the least amount of tax over 10 years? Now, pre this new law, which sounds like you were in, then none of this applies. You now get to take it over your lifetime, and the brokerage firm should tell you every year what your RMD is, and you got, most of the time, I recommend my clients take their RMDs in December because to get it in there growing tax-free as long as possible, unless you really need the cash, right? If you don't need the cash right away, wait until December and you just take it in December. Plus, if I do everybody at the same time, I don't forget, right? In fact, I got to do that. One thing I'm working on today, actually, is because December 15th, I got to make sure it's cash in all the accounts for those RMDs.
Cool. Thank you.
Sure.
I have a question. So I'm in the middle of this whole transition thing. And prior to being in transition, I went on Medicare, and I had probably a $600 a quarter premium. And I just got a premium bill for starting next year of about $700 a month. So I'm not exactly sure what that is. Why the change might have come in place. Maybe it's because of amount of money I made last year. We sold the house.
Yeah, no, it's because of no, it won't be the house. Here's what happens, right? They have a surcharge that they charge for Medicare, and like the education thing, right? So basically, they just came out with the premiums for 2024. Okay, so and there's an income surcharge, right? So if you're married filing joint and your income's over 200,000, right, and if you're single, it's over 100,000, right? You have to pay a surcharge, and there's a bunch of breakpoints, right? It can be as high as $500. $550 a month per person for Part B, okay, if you're making over 500,000 a year, okay? So what happens is that it does it based on 2 years prior. So because they're coming up with the 2024 premiums, they can't use 2024, it hasn't even happened yet, right? They can't use 2023 because the year's not done yet, so they don't know what your income's gonna like. So they go back to 2022. So your 2022 income, okay, is what determines your 2024 premiums. So my guess is you were still working in 2022, so you had higher income in 2022. That's driving your 2024 premiums. Now they do allow you in a situation where you've lost your job and you've had a transition to appeal that. I'd have to, you send me a note, I can shoot it over to you, but I don't have it, right in front of me. But there's an appeal form that you can file that says, okay, my income is changing because I had a change in a life event. And then they'll take that surcharge away and go back to this, because the standard premium, the standard rate for Part B for Medicare is like right now for 2024, it should be like $174. So it should be quarterly, it should be 174 times 3. So if it's more than that, then you're getting a surcharge, right? You're paying the income surcharge, and you should be able to appeal that if your job was eliminated, you're no longer working.
Okay, so while I'm in transition, I might expect to have a lower surcharge.
It depends on whether it's a transition thing or whether it's you're really, if you're just going to plan to get a job of a similar income, then you're not going to do yourself any favors, because then they're going to go back. I just had a client that did that and then decided to go back to work, and now their income was high. And so in the end, they come back and go, no. You told us it was going to be low, but it wasn't low. It was high. So now there just has to pay that all back as a lump sum, the difference. So if you're genuinely like retiring, right? Well, then, yes, then you would do that. If you're just going to say, I'm going to get a job earning that next year anyway, then it may not be worth the appeal. It really depends on what you're planning to do.
Got it.
So is your income in 2024 really going to be below the threshold? right?
Yep.
And again, that threshold is very different whether you're single or married filing joint. But
Yep.
yeah, if you want to call me, you can call me. We can talk about it if you want.
Yeah, sure. Thanks.
Anything else?
Well, Sudha, William, Bill, thanks
right.
very much. Oh, I'm sorry. Did someone I heard? So thanks very much. I always enjoy this program every year, and actually, I'm fortunate enough to see it probably 2 or 3 times a year. It's always chock full of great information, and I'm glad you're both continue to be supporters of the Breakfast Club of New Jersey. And before we officially wrap up, Frank, if you have a comment or two to make.
I would just echo David's sentiment. Bill, we really appreciate this every year. You come in and help the members in transition and those that are, experiencing different life events where the information and the insights are very critical to them. So we thank you greatly for your support.